Morning from Big Bear, California again this morning. It's Monday morning, 8:30 a.m. Pacific Standard Time. I hope everyone had a great weekend. What we are going to talk about today is real estate. So we can, obviously in these videos, all we're able to do is really dip our toe in the water when we're having these conversations. But what I want to talk about today, and I had an interesting question on Friday that I'll address, is from a personal financial perspective, is it a good time to buy a home when rates are high, prices are still relatively high compared to where rates are and where prices should be or should go? And so I'm going to answer that. What do you do in that market environment? But the first couple of things I want to talk about is what creates a real estate market and what moves a real estate market. I think it's very important to understand this because I think falsely a lot of times what people are told is that I buy houses, I buy real estate because it's real, right? It's a structure. It's made out of wood, it's nails, concrete. It's made out of real things. It's solid. It's not the same as buying a stock. It's not the same as buying paper. So I want to address, well, how does that market actually move? So let's just get right into that. And one of the first things we'll talk about, because it's something that we're dealing with right now, is interest rates. Interest rates have more to do with real estate than any other component. There's one other component that is very strong, which is consumer demand. But we're going to talk about that demand and how it's generated. Interest rates, on the other hand, have played, have been tumultuous for real estate investors forever because interest rates are out of your control. That's something that gets moved when the Fed wants to move it. The Federal Reserve is not federal, so I hesitate to say the government. However, the Federal Reserve does work directly with the government. So you'll probably hear me refer to the government and the Federal Reserve, and I'll interchange those terms. However, just realize that the Federal Reserve is a privately owned, for profit institution. Okay? So interest rates. Well, I remember when I got started as a wealth manager, financial advisor in 2004. I worked with a great company, A.G. Edwards, family owned up until 2008, 2009, obviously, when they all got destroyed. But when I started there, everybody said that we were at historic low rates. This is unbelievable. And that we should really be careful when we're investing for our clients because rates are destined to rise. That's what we were told. Well, fast forward to 2007, rates had risen, right? They did rise. But what rates rising did is what it always does. It started to topple the real estate market, right? And then when the real estate market started to topple, that trickled in to the economy, which then trickled in to our credit, and it created a credit freeze. So let's talk about those interest rates and what they mean and where we're at today. So first, let me tell you something that everyone should be talking about right now. And everyone, if you're a homeowner, if you're an investor, if you own an Airbnb, whatever the case is, it doesn't matter. You should be aware of this. The 10-year note has crossed over 5% for the first time since 2007. Why is that important? Well, I don't know how many people remember the real estate market from 2007 through 2010, when it had fallen 50% in a lot of places in the US. Even in conservative places, it was down 20, 25%. Now, why is that? Well, it's simple. It's really simple. When interest rates rise, when they go up, the cost of things is far more expensive. And I mean far more, especially when you start talking about real estate, because most people that are buying real estate are buying very long-term notes. They're buying the 30-year mortgage. So, and then if you're a gambler, heaven forbid, and you're buying variable APRs, meaning as rates move each month, so does the cost of your mortgage, you're hit even faster and you're hit even harder. But let's talk about the 30-year, because I don't encourage, unless you're extremely savvy and you really are in the markets and you've been doing this for a long time, I don't encourage anyone to get variable APRs or interest-only loans. I think they're a recipe for disaster. Markets like this, will get you kicked out of your house very quickly if you get that wrong, because you simply won't be able to afford to be there. So with a 30-year, let's talk about what rates are. So you have yourself a $400,000 loan at, say, 4.25%. That $400,000 loan is going to cost you about $1 million. Your mortgage is going to be about $2,300. Take that same $400,000 mortgage, now make your rate 7%, 7.5%. The cost of that home in total over 30 years is going to be more like 1.5 million, and the cost of your money, the cost of your mortgage each month is probably closer to 3,600. That sounds crazy, right? I mean, that's what's going on right now. So when people tell me, and I have these conversations all the time because I'm in finance, so people bring them up, and their opinions are funny, because their opinions are a lot of times just based on what they would like to believe rather than what actually happens. If you take a mortgage that was 2,300 and you turn it, I don't care, call it 3,300, you have just priced out 70% of the people that got that mortgage at 2,300. Most people do take their mortgage about to what they can handle, what they can stand. Why? Because it gets them a nicer house. And I'm not necessarily against that. This life is to be lived and enjoyed. And if you wake up and you're happy, and you wake up in your house and you're happy, who am I to tell you that pushing that threshold of 35% of your income each month for rent is a bad idea? And by the way, that is the threshold, folks. If you are over that 35%, that's kind of a personal finance rule. 35% really should be your cap. So if you're looking to buy a home and you're making $10,000 a month, that mortgage should not exceed $3,500. Okay, that's kind of the cap. But back to our conversation. I just want to throw that out there for you. Back to our conversation. So if that's the case, and we now have 70% of the people that can afford a $400,000 home priced out, what does that do to the cost of homes? Well, if you want to get 100% of those buyers back in, they could afford $2,300, and rates stay where they're at, that means the price of that home has to fall to a point where you're paying $2,300. In this case, what is that? 300,000, 290,000, somewhere in there. I'm not sitting here with a calculator, right? But that's where prices have to go just to put those people back in the market. And that's not even to bid up the price. Let's remember something. When I say bid up the price, I mean like anyone who's ever bought a house. You want to buy it for less and sell it for more. So if you bought it for 400, you're certainly not looking to sell it for 400. You're looking to sell it for 450. Well, if rates stay where they're at and prices have to fall to 300, 330, whatever it is, it doesn't matter. You can't sell until you've exceeded 400,000. Now, what has to happen for you to exceed 400,000? Well, you can one of two things. Rates decline again. They get pulled down, or demand increases, consumer demand. And that's not going to happen. We just talked about why. Listen, when you get to a point in an economy, and in a capitalist economy, this happens all the time across the board with all asset classes. People get carried away. They get emotional. What do we talk about all the time in these talks? You cannot get emotional. If you get emotional, if you get excited, or if you get fearful, you are making a mistake. Odds are you are going to make the exact opposite decision that you should make once you are emotional. So now we can see how interest rates impact a market. Let's talk about what else impacts the market. How about demand? So let's go ahead and just talk about something that impacted markets in 2020, 2021, 2022, and now we're finally seeing some of that. Well, a lot of people left the state of California, and they chose Texas and Florida. Well, a lot of people left California and New York. New Yorkers tend to choose Florida. California chose Texas. Why? Prices had gotten so high in that area. The COVID restrictions were very, very difficult to deal with. So they left. Now, is that real demand or is that artificial demand? Well, if history tells us anything, it's that when these events happen and people move geographically to a new area that they are not familiar with, once that event ends, people go back. And we're seeing that right now. So a lot of the price increase that went on in, say, a Texas and a Florida, the reality is when those people leave and sell and they go back home, which most of them will do, they're going to be affected probably more than other places when the real estate prices fall. They should fall further, right? So events, that can create false consumer demand. The other thing that creates demand, and this is new, obviously, but Airbnbs. People realized, especially when a lot of people, although there was all these COVID restrictions, a lot of people spent their time traveling through that time. And Airbnbs went gangbusters because these weren't long-term rentals where you were looking to make $2,000 a month or $3,000 a month. Some of these guys are making $10,000 and $12,000 a month in homes that they couldn't rent for more than $2,300. They thought they had cash cows. But again, there was an event that sparked that all of that was false demand for Airbnbs. There was an event that caused that demand. When that event ends, that demand ends, and that's why Airbnb owners I think Austin, Texas is the #1 city being battered right now. But I'll bet you it's all. I mean, it is nationwide, right? But Airbnbs, that was false demand. That drove regular people's price of their home up. It did. It absolutely did. And the final component to drive a real estate market that we talked a lot about on Friday, so I'm not going to get into it again, is increasing the currency and circulation of a country. In the U.S., we increased our circulation by 50%. In Canada, they increased theirs by 35%. I mean, this was a global phenomenon, by the way. So this is no way independent of the United States. We weren't the only ones. That's why we're fighting global inflation right now. But that's another piece of the puzzle. Something else this is another component, a smaller component at the moment, but it's become a larger piece of the puzzle than it's ever been historically, and that would be corporate ownership of private homes. Okay? So corporate America is buying up houses. And the scary thing about corporate America is while you borrow at 7%, they borrow at 0.5%. Well, your household income, most people are living check to check. In fact, they say over 50% of the population, if they got into a jam and needed to raise $1,000, they could not do it. Corporate America doesn't have those problems. They just don't. They can weather storms far better than you ever can. They have more borrowing power. They will outlast you. If you think you can compete with Apple or Tesla or any of these giant corporations, you're out of your mind. And they are competitors in the real estate market now, again, going back to Friday's live event, that can either be really scary or that could cushion the fall. It depends on how you want to look at it. If you're looking at it from a long-term perspective, you absolutely do not want that. From a short-term perspective, probably make you feel pretty good, right? So that is another component of the real estate market. So let's talk a little bit about whether or not right now you should be buying a home or you shouldn't. Well, there's two types of home ownership. The first is you're buying the home in which you live. And this is what I tell everyone. When you're buying a home that you plan to live in for life, I'm not talking about flipping a home. You're going to live there, you're going to raise your family, or you're going to live there independently for the rest of your life. Affordability is what matters. Is it affordable? A lot of guys are going to tell you that, hey, look, evaluate what rent is, evaluate what your cost is. That is just not my stance. I can see that argument, but that is not my stance. Home ownership, not only does it protect you, but you are making money on an asset that you don't own. This is what I mean. If you have a $400,000 mortgage on a $500,000 house, if that house goes up $50,000, 10%, right? It goes up 10%. It went up $50,000. That isn't a 10% return to you. You only put $100,000 down. That's why your mortgage is $400,000. You just made 50%. You made 50% of your asset. You can't do that anywhere else. And if you live in the home, you're not really that concerned if it goes up or down. You live in it. It also protects you from different events happening, right? If you own a home, you have access to borrowing, right? You have access to more money. You're gaining more interest on an asset that you don't even own. And whether your rent was $1,600 and you're paying $2,300, it really has no bearing. The price in real estate in the US, the average increase per year is 4.5%. Let's just call it 5% for argument's sake. That is $25,000 a year on a $500,000 house. Now, here's the kicker: you only put $100,000 down. You're making 25% per year. You cannot beat that as long as you can afford it. And we talked about the affordability model. It should never surpass 35% of your monthly income. If you follow those rules, and this is the home you're buying to live in, and you can afford it, I see no reason you do not buy a house right now today. You may pay more than you would have. The market may correct, just like I told you I believe it will. But in the end, you will average 4.5% on real estate. It's a good deal. Now, would I go into investment real estate right now? Absolutely not. Are you crazy? I would not be buying investment homes. Absolutely not. I don't care what the cash flow on the rent is. I don't care about any of that. There's too much unforeseen future in front of us right now. There's no way I would ever do that. Look, it can go terribly wrong. We can fall 50, 60%, or maybe that's cushioned and we don't fall quite as far. Now is not the time to invest in real estate. You do not invest in real estate when interest rates are skyrocketing. We've gone from, being able to get a 3% 30-year mortgage a year ago to being at like 7.7% today. You absolutely do not buy investment properties when that's going on. I think, so let's talk a little bit. I want to hit one more point. I think I've gone on a little longer than I planned on. Again, I don't want to make these too long. I don't want to bore people. You know what? I'm going to leave it off here. What we're going to talk about in the next real estate conversation, we're going to dig deeper into real estate itself. We're going to dig deeper into the driving force behind it, what it means to you. We're going to look at it from a personal financial perspective, and we're going to look at it from an investment financial perspective. Thank you for joining me. I go live on Instagram at 9:30 a.m. Pacific Standard Time. I hope to see you there. I hope this was valuable to you. If you have questions, please reach out to me. And I'll happily answer them. All right. Thanks for tuning in.